You hand over $5 for a coffee, and it looks like the simplest trade in the world. But part of that money pays the barista who smiled at you, part pays the farmer who grew the beans, and the rest is split between the landlord who owns the corner and the bank that financed the espresso machine. Whatever survives that journey, a few cents, is profit, and somebody has to track where every single cent went. That system runs every business on Earth, and today, you learn its language. No background needed. Stay to the end, because I'm handing you the whole chapter on one card you can screenshot. Start baby simple. A business is a machine. You feed it inputs, beans, labor, a rented corner, and it turns them into outputs, things people will pay for. Why build the machine? Profit. And profit has a formula, the most important one in business. Profit equals revenues minus expenses. Revenues are what customers pay you. Expenses are what the inputs cost you. Money in minus money out, and whatever is left is yours. And if what's left is negative, that's called a loss. Or as I tell my students, congratulations, you've invented an expensive hobby. Machines come in 3 flavors. Service businesses sell help. An airline, an accounting firm, a barber. Merchandising businesses resell products they buy from someone else. Costco, Walmart. And manufacturing businesses make their own products from raw materials. Tesla, Toyota. Service sells help. Merchandising resells. Manufacturing makes. Yours is a coffee shop called Maple Bean. It sells a service with a product in the cup, and it opens today. Now the star of the course. Accounting is an information system that reports the economic life of a business. In plain English, it's the diary of your business, written in money, so anyone can read the story later. That's why it's called the language of business. It does 3 jobs, always in this order. It identifies the events that touch money, out of everything that happens in a day. It records every single one, a careful dated history. Then it communicates the story in reports and explains what they mean. Identify, record, communicate. I-R-C, 3 jobs. That's the whole subject, and everything else is detail. Quick question, and students always ask me this one. Is bookkeeping the same as accounting? Not quite. A bookkeeper does one of the 3 jobs, the recording. An accountant does all 3, writes the diary, reads it, and tells you what the story means. And who reads this diary? 2 audiences. Inside the walls, managers use it to decide, should we raise the price of a latte? Can we afford a second machine? That's managerial accounting. Outside the walls, investors deciding whether to fund you, lenders whether to trust you, and the tax office. Financial accounting, same diary, 2 very different readers. Imagine a league where every team kept its own rulebook and its own score, because nothing could be compared or trusted. That is why accounting has one rulebook called GAAP, the Generally Accepted Accounting Principles. In the United States, the FASB writes that rulebook and the SEC polices it. Most of the rest of the world follows IFRS from the IASB, and the 2 systems keep converging. That single shared rulebook is the reason the numbers mean anything at all. 4 rules from that book matter today, and we'll take them in pairs. Rule 1. The economic entity assumption. Your shop is its own person. Its wallet is never your wallet. Buy groceries for home with the shop's card and you've broken this rule. The books record the business's life only, separate from yours and every other business. Rule 2. The monetary unit assumption. The diary is written in money, so you record only what money can measure, in stable dollars. Your barista's charm? A loyal customer's smile? Priceless and unrecordable. If a dollar sign can't touch it, the diary doesn't hold it. Rules 3 and 4 are a pair, and here's where students slip. Historical cost. An asset goes on the books at what you actually paid, because a receipt is evidence and an opinion is not. Say a company buys land for $100,000. 10 years later, everyone agrees it's worth $300,000. The books still say $100,000. That feels wrong the first time, and it's supposed to. Cost is about proof. Now the exception? Fair value. When a market price is 1 click away, use it. Apple shares? You can look up today's price in 1 second, so they're reported at fair value. The office building has no price tag, so it stays at cost. Say it with me. Easy to price, fair value. Hard to price, cost. One more thing about that rule book, and I'll say it plainly. Rules only work if people follow them. Ethics is the glue. When managers invent numbers, real people get hurt. Employees lose jobs. Retirees lose savings. That's what happened at Enron, one of the biggest frauds in history, and it's why the diary must be honest before it is anything else. Here's how I frame it for every student. Your numbers are a promise to strangers. Investors you'll never meet will bet their savings on what you write. Write the truth. That closes Act 1, the language and its laws. Take a breath. Still here? Good. because Act 2 decides something personal: who loses their house if the business fails. Before you unlock the door, one legal decision: own the shop alone, and it's a sole proprietorship, cheap to start. You answer to nobody. But its debts are your debts. About 70% of American businesses bring in a partner, and it's a partnership. Shared resources, shared control, profits taxed once as the partner's personal income. Or turn it into a corporation, its own legal person that sells shares called stock, gives its owners limited liability. Creditors can take the company's assets, but never your home, and it outlives every founder. 20% of businesses, but almost all the giants. Then there's the crowd favorite, the LLC, the limited liability company. Limited liability like a corporation, profits passing straight through like a partnership, taxed once. Best of both, which is exactly why it's so popular. The family also has specialist forms: quick tour, the limited partnership. One general partner runs it with full liability. The limited partners just invest. The LLP protects innocent partners from another partner's malpractice. That's why big law and accounting firms use it. The LLLP extends that further, and the S corporation kills double taxation but caps you at 100 shareholders. The takeaway is one sentence: write it down. The structure decides who is liable and who gets taxed. Pause and try this one. A friend wants limited liability but hates double taxation. Which two structures should she look at? Pause now. The LLC or the S corporation. Both shield her personal assets. Both are taxed once. Nice work, future CFO. That's a real conversation people pay advisors for. Now, everything so far was vocabulary. What comes next is the machine itself, and it's the reason this chapter exists. You open Maplebean with $10,000 of your own savings. The instant that money lands in the till, a law switches on, and for as long as the shop lives, it never breaks. What the business owns equals what it owes, plus your stake. Assets equal liabilities plus owner's equity. Before I draw it, predict. 10,000 in, nothing owed yet. What's your stake? Picture a balance scale. On the left pan, 10,000 of cash, what the shop owns. On the right pan, 10,000 of your ownership. Level. And here's how I think about it. The scale is not level by luck, it's level by construction, because every event that ever touches this shop will touch both sides at once, or two things on one side in opposite directions. One more thing while the scale is fresh. If the shop ever closes, creditors are paid first, in full. Your slice is whatever remains. That's why equity is called the residual claim. So what are those three words really? Assets are what the shop owns, the resources it uses to make money. Cash, the espresso machine, the beans, and even money customers still owe you, because a right to collect is a resource too. Some you can touch and some, like a trademark, you can't. Both count. Liabilities are what the shop owes. The unpaid supplier bill is accounts payable. A written promise to the bank is notes payable. Wages owed, taxes owed, all of it. Every liability is a promise that somebody gets paid before you do, and your bank politely calls that promise Tuesday. And owner's equity is your slice, what you put in, plus every dollar of profit you left inside the shop. Now watch the equation grow. Pure derivation, nothing new, I promise. Start from the law you already own. Assets equal liabilities plus equity. But equity isn't frozen, it breathes. So let's open it up. Your stake is what you put in, minus what you take home, plus what the shop earns, minus what it consumes. Four forces, only four. Capital, you invest and equity rises. Drawings, you take money home and equity falls. And listen, drawings are not an expense, the classic exam trap. Revenues, selling coffee, catering an office, equity rises. Expenses, the rent, the wages, the utilities consumed to earn that revenue. Equity falls. Now substitute those four back where equity sat and read the whole line with me, slowly. Assets equal liabilities plus capital, minus drawings, plus revenues, minus expenses. Two up, two down. Miss the drawings line on an exam and your equity is wrong by exactly that amount, and nothing on the page will warn you. Not everything that happens in your shop gets recorded. A great review doesn't. A handshake doesn't. A transaction does. Most are external, between the shop and the outside world. A sale, a bill, a loan. Some are internal, inside your own walls, like supplies quietly being used up. We'll catch those later with adjusting entries. Chapter 3's job. The test is one question. Does the event change assets, liabilities, or equity? If yes, record it. If no, it's just weather. That's the end of the theory. Everything from here is practice, where the subject is actually learned. Welcome back. Now we work the machine. 13 real transactions, 1 month of Maplebean's life. And for everyone we ask the same two questions. What moved and why? When I taught this live, this drill is where accounting finally clicked. Transaction 1. You invest $10,000 cash. Cash up $10,000, capital up $10,000. Because from the shop's point of view, your money isn't a gift, it's your claim. Transaction 2. You buy the espresso machine, $6,000 cash. Cash down $6,000, equipment up $6,000. Notice, the shop is not poorer. One asset traded for another, that's a swap, and total assets don't move. Transaction 3. Watch this one closely. $900 of supplies, $300 in cash, $600 on account. Supplies up the full $900. You own the pile the moment it hits your shelf. Cash down only $300. The other $600 is a promise to pay, accounts payable, up $600. Now the shop earns. Transaction 4. A week of coffee sales, $4,000 all cash. Cash up $4,000, and this is not a swap. You gave up no asset, you gave up effort. So the shop genuinely got richer. That growth is revenue, equity up $4,000. Transaction 5. You cater an office breakfast for $2,000 on account. No cash yet, but the work is done, so the revenue is earned now, not on payday. What you hold is the customer's IOU, a legal right to collect, and a right to collect is an asset. Accounts receivable, up $2,000. Transaction 6. You borrow $1,000 from the bank on a signed note. Cash up $1,000, but this money arrived with a string attached. It has to go back. Borrowed money is never revenue. You're renting money. Notes payable, up $1,000. Quiz time. And this is the one that catches half of every class. Next week, the office pays the $2,000 it owed you. Your cash goes up. So here's the question. Is that new revenue? Pause now. Commit to an answer. Say it out loud. Ready? No. You earned it back in Transaction 5 when you did the work. This is simply a swap. The paper promise turns into cash as receivables fall. Counting it again would be counting the same breakfast twice. Want 10 more like it? The quiz generator on the site builds them. Free. 4 quick ones. Future CEO. Transaction 7. A $450 grinder on account. If you did the Focus video's homework, this is that exact problem. Welcome back. Equipment up $450. Accounts payable up $450. Transaction 8. Rent $500 cash. Cash down $500. And unlike the machine, you got nothing you can keep. The month of space is already gone. Money spent with nothing left to own is an expense. And here comes my favorite tip in all of accounting. The expense account itself goes up. Rent expense, up $500. But expenses sit inside equity with a minus sign. They are inversely related. So as the expense rises, your equity falls. Expense up, equity down. Revenue up, equity up. One pattern reads straight off the expanded equation. Transaction 9. The office pays its $2,000. You just proved this one in the quiz. Swap, cash up, receivable gone, no new revenue. Transaction 10. You take $200 home for groceries. Drawings, a direct cut to equity, and say it with me, not an expense. Drawings up, equity down, the same inverse pattern. Last stretch, then we prove the month. Transaction 11, the bills, $900 of wages, $300 of utilities, $100 of advertising, $1,300 of expenses, cash down, equity down. Transaction 12, and I've graded this mistake 100 times. A $400 ad bill arrives, and you postpone paying it. The ad already ran. The expense already happened. Recognition doesn't wait for cash. Advertising expense up $400, accounts payable up $400. Transaction 13, you pay the $600 you owed for supplies. Cash down $600. Accounts payable down $600, and equity feels nothing. You're settling old business. Now we prove it. Cash, $8,100. Supplies, $900. Equipment, $6,450. Total assets, $15,450. Liabilities, accounts payable, $850. Plus the note, $1,850. Equity, capital $10,000, minus drawings $200. Plus revenues, $6,000. Minus expenses, $2,200. $13,600. $15,450 equals $1,850 plus $13,600. Balanced, 13 for 13. You just did a full month of real accounting, and I mean that. Here's the pattern behind everything you just watched, and it's the biggest idea in this course. Every single transaction touched at least 2 accounts, never one. No transaction on earth touches just one account, and the equation stayed balanced after every row. That idea has a famous name, double entry accounting. It's roughly 500 years old, and it's the whole of Chapter 2. Do that all month and the shop can finally speak through 4 reports, always built in the same strict order because each one hands a number to the next, like runners passing a baton. Report 1, the income statement, also called the P&L. One question, Did we make money over the period? Revenues, $6,000. Expenses, $2,200. Net income, $3,800. Positive is net income, negative is a net loss. And one warning before we move: your investment is not revenue, and your drawings are not an expense. The income statement excludes both. It only measures the business doing business. Now watch the baton pass. Exams love this part. Report 2. The owner's equity statement. Start at beginning capital, 0. Maplebean was born this month. Add your investment, $10,000. Add net income. There it is, the $3,800 handed over from the income statement. Subtract drawings, $200. Ending capital, $13,600. That number now sprints to report 3, the balance sheet. And the balance sheet is different, not a period, a photograph, one moment. Assets, $15,450. Liabilities, $1,850 plus equity. Exactly the $13,600 we just calculated. The balance sheet is the accounting equation printed on paper. Lenders read it with one quick ratio: liabilities divided by equity. Here, $1,850 over $13,600, about 0.14. For every dollar you have at risk, creditors have 14 cents. Low number, easy loans. And one more term. A calendar year ends December 31st. A fiscal year is any 12 months you choose. The last report is the statement of cash flows, and it answers the question, profit can't. Where did the cash actually go? 3 buckets: operating, the day-to-day, coffee money in, rent and wages out. Investing, buying or selling long-term assets like the espresso machine. Financing, money from owners and lenders. Your investment, the banknote, your drawings. Remember it this way: profit is an opinion, cash is a fact, and this statement tracks the facts. Plenty of profitable businesses have died waiting for cash that arrived too late. Screenshot this. The whole of Chapter 1 on one card. The 3 jobs, the rulebook and its ethics, the legal forms, the equation expanded, and the 4 statements in strict order. On an exam, this chapter comes at you exactly 2 ways. Define and classify, or push a transaction through the equation and prove it still balances. You just did 13, so you're ready for both. Full mock exams and practice on exactly this chapter are on the site, all free. And here's the sentence I promised you. Assets equal liabilities plus equity. Every chapter after this one is just a new way of keeping that single line true. One last customer, and I'm not solving this one for you. You buy $120 of espresso cups on account. Name the accounts that move and the direction each one takes. The worked answer is on the site with the notes, exercises, and mock exams, all free. And the free weekly newsletter brings one market recap and one options flow breakdown every week. Chapter 2 is where the equation grows its famous tools, debits and credits, and you're more ready than you think. So subscribe and meet me there. Every expert you admire once sat exactly where you're sitting, future CPA. The only difference between you and them is the next chapter.